What is smart asset allocation according to you?
In asset allocation, we decide how much of your investable surplus is allocated to different asset classes. For simplicity, think of it as two asset classes, debt and equity. This split is decided by a risk profile, that is your ability and willingness to handle risk. There are three kinds of risk profiles: conservative, moderate and aggressive. And the split between equity and debt is 40-60, 50-50 or 60-40. This is what is followed by most advisors. In smart asset allocation, which we do in our Omega solution, we follow the same, except that this is the allocation when the market is hovering at its fair value. When the market moves up and continues to move up, we reduce the allocation to equity and move it to debt. Similarly, when it moves down, we increase the allocation to equity and reduce debt. However, we maintain a minimum allocation to debt, different risk profiles, so that investors are able to handle the drawdowns and their emergencies.
How does one assess whether the market is at its fair value?
We have been valuing the top 200 stocks for the last 10 years to arrive at its fair and full value, what we call its MRP. If all the stocks in Nifty 50 and Sensex 30 were to be at its MRP, we would arrive at what we call Nifty at MRP and Sensex at MRP, the levels at which we would say the market is fairly valued. So when the market is above this level, it is overvalued, and below this level is undervalued. However, it is important to note that this is not a static number and usually tends to increase with time.